This is Andy Chambers. Thank you for joining me for today's update. Today we're going to focus on price action. In my opinion, price action is the key to great trading. Unfortunately, price action is often overlooked or obscured by an overload of indicators or by compressing the charts so much that the price action isn't clear. Price action analysis helps us spot key individual bars on a chart, as well as identifying the swing highs and swing lows that make up a trend. We know that an uptrend has a pattern of higher swing highs and higher swing lows, and a downtrend has a pattern of lower swing highs and lower swing lows. Price action trading offers a specific way to define the swing highs and swing lows that make up the trend. A swing low is a bar with at least two bars with higher lows on each side of the low bar. Once again, a swing low is a bar with at least two bars with higher lows on each side of the low bar. Here's a picture of a recent swing low on the daily chart of the Dow. As you can see, there are at least two bars with higher lows on each side of the low bar. The weekend after the Thursday, August 8 low, I let my newsletter readers know that it looked like a low was in place. One of the advantages of being able to precisely define the swing highs and lows is that you also know exactly where the setup is wrong or the setup is void. In this case, a break of support at the Thursday, August 7th low would have voided the swing low setup. As you can see, the relatively low-risk setup turned out to be an excellent buying opportunity. The Dow rallied about 600 points over the next 10 trading days. A swing high is a bar with at least two bars with lower highs on each side of the high bar. Once again, a swing high is a bar with at least two bars with lower highs on each side of the high bar. Here's a picture of a swing high on the daily chart of the Dow. As you can see, there are at least two bars with lower highs on each side of the high bar. A few days after the July 17th high, I let my newsletter readers know that we had a downside target of 16,400, which the Dow barely pierced before it rallied again. Here's a monthly chart of the Dow that clearly depicts the pattern of higher highs and higher lows that's been in place for several years. The red arrows mark the swing highs, and the green arrows mark the swing lows. As I said earlier, price action trading makes us aware of key individual bars, as well as helping us recognize and define the pattern of higher highs and higher lows, or lower highs and lower lows on the chart. Right now, the monthly bar for August, last month, looks very important. The bullish monthly bar suggests a further advance. However, a monthly close below the August low would indicate that the bull move could be over for now. Now we're going to go back a bit. Back in 2011, I said that the big bullish reversal bar, looking at an individual bar, that's marked by the lowest green arrow could mark the beginning of a big, long move up. Wide range reversals like that can be very significant on any time frame. The longer the time frame, the longer and stronger the impact can be. As you can see, the bullish setup worked out extremely well. Well, in just a few minutes, we reviewed a simple method for defining a swing high or swing low, and we noted that wide range reversal bars can mark the beginning of big moves, especially when they're like the big bullish reversal on the monthly chart that also marked a higher low bottom. Another way to qualify setups is to look for positive divergence. You can use your favorite momentum indicator to do this. We're going to use the stochastic. We have a positive divergence setup in a bull trend when the price low is higher than the previous swing low in price, and the stochastic makes a lower low than the previous stochastic swing low. As we noted on the chart, we're looking for a higher price low and a lower stochastic low. That simple setup ultimately yielded to this big multi-year move. Please note that the stochastic reached the overbought level very early in this big move, and it's remained overbought for years since then. Don't let an overbought momentum indicator scare you out of the trade. Wait for price action to confirm a change. Okay, the monthly setup we looked at was from 3 years ago. What about now? Well, here's a daily chart of the E-mini futures. Although it's a futures contract, I use the E-mini to give me an idea of what happened in the stock market over the last 24 hours, not just during the normal U.S. market trading hours. We've said we like wide range reversals. After the wide range bullish reversal day on August 8th, I told the newsletter readers it looked like a bottom was in place. As always, we knew exactly where we would be wrong. A break of support at the August 8th low would void the setup and tell us we were wrong. As you can see, the bullish reversal marked the beginning of a very nice rally. We've said that we like big bullish reversals or big reversals in the direction of the trend. They can be bullish or bearish. We know that the trend in the stock market is up, and the previous chart clearly showed the big bullish reversal that occurred on August 8th. This chart is more compressed, so the individual bars are more obscure. I'm using it to show the power of a nugget of market wisdom that someone shared with me years ago. The gentleman simply said, buy a bull market that's oversold into support on signs of a bottom. The depth of the stochastic decline on this chart shows that the E-mini was deeply oversold on a daily basis. The red horizontal line shows that it was oversold into support. The big bullish reversal setup that we looked at was the sign of a bottom. It turned out to be an outstanding setup. Once again, I'm going to share that nugget along with the similar bearish line that he stated to me. Buy a bull market that's oversold into support on signs of a bottom. Sell a bear market that's overbought into resistance on signs of a top. Well, that's it for today. Thank you for your time and attention. Good luck and good trading.